Hi, everybody. If you've never heard me before, welcome. Hopefully, I'm going to give you some new stuff that's pretty exciting. If you have heard me before, you're going to hear some stuff repeated that you've heard. Sorry about that. There are just certain truths trading the futures markets that are pretty inflexible, pretty undeniable, and they just keep coming back over and over and over again. If you're like me, sometimes you have to learn lessons many times. I myself get tired of hearing the same adages, but they're bellwether concepts. Pretty much time-tested, eternal, and it's pretty hard to imagine somebody having a successful trading career without incorporating them. So we're going to delve on a little bit of the psychology of trading and why, in my opinion and in the opinion of other luminaries out there, mechanical trading is the answer to solving common problems of trading, of traders and their weaknesses. Mechanical trading, of course, is mathematically based trading, hard and fast rules that are very cut and dry, not open to misinterpretation. One is low enough to buy, two is not, for example. It tells you exactly when to get in the market on the long side, when to get in on the short side, when to take profits, exactly where you take your loss, etc. The obvious advantage, by trading in that manner, you're eliminating the twin adversaries of traders, fear and greed. Now, in my 30-plus years as a trader, you can divide my history into two distinct parts. There was the aggregate triumphs that I enjoyed, particularly with a late trading partner. We had a 10-year history of over 800% return. That was done strictly via mechanical trading. The other half of my career is everything else. My demons, my dark side, taking flyers, trading by guts. Doesn't work for me. And I have to say that I don't feel that I am different than 99.99% of all the other traders out there. You've probably heard the adage that 90 to 95% of traders lose money to the remaining minority because trading is hard. Paradoxically, it could be very simple. If you develop an effective strategy, it's no more difficult than throwing the switch on and letting the machine make the money for you. You'd be amazed at how much easier said than done that is, though. All right, most people are neither systematic nor mechanical. Most people trade according to whatever whim strikes their fancy at the moment. So if you want to be part of that 5%, it stands to reason that you want to avoid all the feel-good stuff that the 95% of the traders use. That way, if you avoid instant psychological gratification, you have a good chance at not winding up in the large, typical trader loser pool. Now, some thoughts on why spontaneous trading doesn't work. Behavioralists have done studies on this, and they have concluded that people tend to be most hopeful when they should be careful and prudent, and most cautious when they should be the most aggressive. In other words, people are resistant to taking losses. They're always on the hope train that the losses will come back. Okay? In a sense, it's crazy because it could be so easy. You take your loss and then your slate is clean to go on, to the next venue where you have a better shot. Conversely, most people fear giving back unrealized profits. Well, there are so many times in my history where I can demonstrate that a huge profit, while it looks awesome and pay a lot of bills and everything, is just the start of something. You have to let your profits run. You've heard that a million times too. Cut losses, let profits run. But that's 180 degrees afield of what our natural inclination is, believe it or not. If you haven't really traded much before, you'll be amazed at that pull that it has on you. You know, wow, ring the cash register. Whew, made my money. On the other hand, oh, I don't want to take this loss. It could come back. Well, that's a way to the 95%. Okay. Most people attempt to impose order where there is none. When you get into the grand and glorious world of mechanical research, you're going to have a zillion ideas based on what the few trades you're seeing in front of you. If the market goes here, then this happens. And, oh, look, it worked here, it worked there, it worked there. But then you expand your search, make your data field bigger, you find out it doesn't work. That's a dance I do like 99 times for every one time that I come up with something that I can save. Okay? We tend to see things that validate our preconceptions, and we tend to gloss over or ignore what is contradicting them. You know, you've all seen that textbook Head and Shoulders at the top and the bottom of charts. And it's so beautiful. From the top, then it just falls out of bed. And from the bottom, it just rallies like a banshee. Well, if you're a hard and fast mechanical researcher, you have to also account for all those head and shoulder formations that happen in the middle of the charts. They're not as easy to see. They're not, you know, they're not acting as borders on the edges. But that's, you know, what is making your mechanical wish fulfillment concept not valid. Because when you're playing a numbers game, you know, it's the wins and the losses thrown into a hopper, added up, and if there's too many things that aren't working, you're going to get negative results, and that doesn't bode well for the future of your trading. Okay, most people, and I should probably just say many people, lose sight of the only real reason to trade, and that's to make money. Well, does that seem like a duh to you? You get involved in trading, you could be trading out of addiction. Trading is one of the most addictive things in the world. Few things reinforce behavior more than intermittent rewards. They've done this on people, on animals. You know, if a rat hitting a lever gets the goody morsels some of the time, and there's no pattern to when, he's just going to keep hitting the lever. That's what trading does. Gives you rewards some of the time. And the really vexing thing about it is the rewards don't necessarily come out of good behavior, and the punishment does not necessarily come out of bad behavior. So there's no reinforcement that you can use. You know, the only reinforcement you get is bad reinforcement. So we've covered this here. People like to ride their losers to even bigger losses and cut their winners short of big profits. That's another way of saying that the trades that we fear the most tend to pay off the most. And I'll tell you, in my personal history, I can demonstrate that again and again and again. This can't possibly work. Yeah, system, great idea. I'm glad I'm a system trader, but not this time. Well, boom. A fortune left on the table. And I'll tell you something. There's nothing worse than that. That hurts worse than a loss. When you know what your blueprint is, you know what the correct behavior is, you don't do it, and you just see something that would have taken care of scores of losses for you. There's nothing more painful from that. Biggest problems arise in trades in which people are the most comfortable, complacent, and confident. I've actually written a book on that, a whole book entitled When Super Traders Meet Kryptonite. And that was a collection of interviews with prominent luminaries on the subject of losses that were like career-threatening, huge losses that were just like stunning, and how they got past it, and you know, the marks of what made them successful under fire. But one of the interesting commonalities on all their stories was that these gigantic losing sessions tended to come on the tail end of highly successful periods. So you've got to be careful when you're in a stride that you don't start getting careless. You know, these traders, they used words to describe their euphoria, you know, bulletproof, walking on water. You get the feeling after a while of, this is so easy. What was ever the problem? That's where you got to beware. Okay, why mechanical trading works? Obviously because it bypasses emotion and the natural psychological wiring. If you're disciplined enough to just follow your blueprint, these traps that we're talking about don't have any relevance. The blueprint itself is not a conscious entity, so it's not going to fall victim to that. All that's going to fall victim to it is you, not making the machinery run right. Larry Williams once said, systems work, traders don't. All right. The other thing is mechanical trading imposes accountability and discipline in following trading rules and working toward your goals. Another way of saying that is if you are relying on nothing but gut, you're never going to be facing hard questions. This is something I witnessed on the floor of the Board of Trade all the time. People would have an excuse for what went wrong with this last trade. Next time they're going to be better, but the next time there's a different excuse. If you're a mechanical trader, you are sometimes forced to make very painful decisions because you have a whole blueprint for just everything you need to know about a system, what your worst drawdowns are, what your largest loss is, what your average loss is, etc. So you know at all times whether, you know, a series of losses that you're taking are within the parameters that you've seen in historic research or they're outside of it. And if they're outside of it, you've got to make some hard-nosed decisions. You know, maybe you're going to have to spend countless more hours refining it, or maybe throwing it out. And these are tough because you just put so much of your hopes and expectations into your systems. But again, you know, you're a mechanical trader. You don't allow yourself to fall victim to wish fulfillment. Well, a seat of the pants trader doesn't have that. They never have to ask themselves tough questions. And therefore, you know, they're just constantly in the same losing loop without even understanding that they're in it or why they're in it. Discretionary trader is only worried about the trade in progress. How much more can I eke out of this? And if it's a loser, when and where do I cry uncle? Mechanical trader, on the other hand, is concerned with a totality of trades. He or she is playing a numbers game. Simple as that. Just like Las Vegas. The big difference between Las Vegas and us, though, is Las Vegas creates their numbers game, and all we can do is uncover ours in a very rough fashion. Now, I was kind of fortunate in my early 20s to become a blackjack expert. I learned card counting. Before that, I had the basic strategy of blackjack down perfectly. And what that taught me is how to follow rules in a non-questioning, robotic fashion. Okay? It's painful to hit those 16s against the 7 because, you know, 8 cards out of 13 are going to bust you straight out, and of the remaining 5 cards, you're not necessarily going to draw something that's going to make you safe anyhow. But if you don't hit it, you just have an even greater chance of losing. So playing expert blackjack is a way of always taking the best move, whether it's hit, stand, double down, or split. Best chance for a winning play, best chance to mitigate your losing plays as much as possible. Now, Vegas has the most efficient moneymaker of all in their slot machines, because not only do they have to, can they count on a long-run outcome, but it's down to the spin. It's pre-programmed. It's going to pay out $50,000, which they're not going to sweat, because before it did that, it took in $250,000. So they've got the ultimate numbers in there. But there are other games, they can't pinpoint it down to the specific hand or spin or roll of the dice, but they don't sweat that because, again, they're looking at the long run, not the short run. You know, the wild cowboy may get hot at the table over here in Section 8, but, you know, Sections 1 through 7 are taking care of that. And that's the way a mechanical trader has to look at it. You're looking at the long run. The short run is very unpredictable, but if you have enough capital going into it, should be enough to meet the requirements of what you're seeing in your performance summaries. You know, you'll know exactly what your worst drawdowns are. You should budget for probably 1.5 times that at least. Given enough capital at the onset and a determination to just follow your system perfectly, your long run should come out roughly like your projections without too much deviation. All right. Now, well, again, we're going to look at some intraday trades that are going to get us in on the open. We're looking at futures markets. Okay, I'm a futures trader, and I specialize in the stock-related indices. That would be the S&P, Dow, NASDAQ, Russell, and MidCap. They're all mini contracts. We're going to be looking at one contract. In on the open, out on the close. Okay, and these particular indicators are going to fall under the heading of what I call either-or indicators. In other words, each one individually will signal a long or a short just about every day, the only exception being when the number exactly ties the number of what the market did. All right, but for all practical purposes, long or short, every day. Okay, these individual, I like to call them building blocks, are raw, robust, and simple. Means I can explain it to you pretty much in one sentence. They weren't messed with, they weren't refined too much. There's not, you know, various rules apply to them. They kind of exist in nature, and they're simple to the point maybe where it'll turn off some of you. But don't let it, because simple is effective. Simple is great. The more you complicate something, the less reliable you're making it. And I've done demonstrations where you can complicate something to the point where you have 9 rules that eliminate every single loss in a historic performance summary. And that's how you get those things in the mail. Those flyers, you know, we've all seen them with the black and the red ink. You know, 2,700% return. One loss in the last 10 years. Are they lying? No, they're not lying. They did achieve that in theory, in history, but they did it by working backward, and it doesn't pretend anything that you're going to be able to use into the future, okay? So that's called over-optimization. And the best way to avoid it is to keep your concepts simple. Few rules good, many rules bad, to paraphrase Mr. Orwell. Okay. So each of these, you're going to see 5 different systems. Each of them is a standalone building block that we are going to be able to combine. Going back to my blackjack card counting, you can give each one a +1 or a -1 value for a buy or a sell bias. You'll find that when we combine them, we can get a whole that is greater than the sum of the parts. We will fully disclose System 1 here. Again, moronically simple. Here's the system. If today's close, okay, let's pretend it's 6 o'clock in the evening and, the market's been closed for 3 hours. Today's close is less than the 5-day average close. And that includes today, by the way. Average out the last 5 days, including today. If it's underneath, you have a buy signal for tomorrow's open. And again, we're only talking regular session hours. We don't deal with Globex. That's 8:30 in the morning until 3:15 in the afternoon, Central Standard Time. If today's closing price is greater than the 5-day average close, then go short. Okay, again, enter on the market open, exit on the close. Again, my specialty are the index markets, and a lot of these indicators are what I call fade indicators, such as this one. We're looking to be a buyer on weakness and a seller off strength. And this is a characteristic that is especially pronounced in the stock-related futures. They have a tendency to revert to the mean, get a little overextended, come back. Even in trending markets, there's a tendency to come back, raid the stops before moving on. The stock-related markets are the most psychological of all the markets. This isn't like your classic agricultural markets that are primarily driven by supply-demand. This is just a big hodgepodge of human emotion, fear and greed. So a lot of the indicators that I use are reversion to mean indicators, meaning looking to buy off lower levels, sell off higher ones. I usually combine that with momentum. It's got to go in my direction before I act on it, but it's a combination, mean reversion with momentum off those levels. So these are the results of that 5-day system. You see something very impressive with the S&P, $61,000, 108,000 in the Russell. We get a non-conforming market in the mid-cap. I'm not going to worry too much about that, though, because we have an overall tendency here. And, again, this is a building block. This is not intended to be a system. Think of this as education purposes only, but it's going to be useful in building the system. All right? And what you're going to see when we combine it with the other 4 indicators is that we're going to smooth out the weak areas. Right now, the mid-cap is the weak area. Okay? But it'll be the strong one, some of the others. Now, you might be asking yourself, how do other daily averages work? Do they maybe work better than 5-day, 7-day work better, 20, whatever? How do we know? Well, again, that's testing. All right. All trading platforms will allow you to do optimization studies. That's the study of variables. You set a low variable and a high variable and an increment in between, and the results will be all the numbers that you've tested for, stacked one on top of another that you can compare and contrast. And it'll give you the net profit, and it'll give you a bunch of other stats as well, your average trade, number of trades, etc. Now you can optimize according to different things. It doesn't have to be according to the best net profit. It could be according to anything, according to the greatest profit per trade, greatest percent profit, whatever. I optimize according to that last column, ROA. What that is it's your net profit divided by your max drawdown. And when you multiply that times 100, you get a percentage. That percentage represents how much your account would have increased, assuming that you started with the worst drawdown amount. So in the top example, it assumes you started with $11,945. You see that under max DD, second column from the right. And the resulting $61,857 is a 517% increase. So what that column is telling you is not only what you made over that historic period, but what you made pretty much in relative terms. How much heat did you have to experience to get there? So that's what I pretty much always optimize for, return on account. Okay, I don't think I mentioned that this data field is roughly 10 years. I set my trade station start to January 1st, 2005, and this is up through this year. Every trade is penalized $5 slippage commission. All right, now take a final look at these numbers, and we'll move to the next system, which is very similar in terms of its simplicity. Again, in on the open, out on the close. You can see that mid-cap is no longer a problem. We've got the NASDAQ slightly lower for purposes there of break even, and confirmation pretty much everywhere else. All right, the third system, especially friendly to the Russell and the mid-cap, not so much the S&P and NASDAQ, obviously, but then we go to system 4, and that problem is mitigated. So hopefully what you're seeing here is that, you know, we're testing these building blocks individually. We're making them stand up on their own, and they're standing up fairly well. Not perfect. It's kind of like trying to get a Rubik's Cube to line up perfectly, but we're seeing tendencies. And by combining these, we're shifting the weak points. We're sort of flattening them out. Okay. Finally, we have system 5 here. Maybe the best one overall, not a loser in the bunch. Okay, so 5 building blocks, each one is assigned a +1 or a -1 value. We could enter the market tomorrow on the opening in the direction of a simple majority, if you like. We could make it so that all 5 systems have to be in agreement. Of course, we'll get a lot less trades then, but maybe the numbers will look a lot better. What I have found to be most effective is to make the systems to enter if you have a +2 or greater value on the long side, or a -2 or less value on the short side. So that's kind of another way of saying at least, well, 4 out of 5 systems have to agree. You can make it 3 out of 5 if one of them's a tie. Okay? That's how you get a value of +2 or -2. And this is this is what we get. I'm comparing the combination to the first system, the 5-day one that we disclosed. It's worse in some areas, but overall better. Particularly look at the max drawdowns. They're more reasonable, easier to live through. You wouldn't want to go through a $40,000 mid-cap one on the 5-day system, but it's knocked down by more than half when you combine these. And the return on accounts overall are better. If you're not real excited yet, don't panic. We have one more little ingredient to put in our stew here. It's a volume filter. Okay? So one more rule. It's clearly not too many. Remember, we've made each of these building blocks conform on their own, perform on their own. Just did a simple combination, and now we're just saying don't take the trade if the filter doesn't conform. All right, so those are your green numbers, the third rows, and you've got something that could be considered a bona fide system here. Okay. Return on accounts. They're all in the neighborhood of triple your money over the 10-year period or greater. Look at the NASDAQ, 780%, 565 in the S&P. Your average trades are well in excess of slippage commission problems. If you made it considerably harder than the $5 per trade, you'd still be exceeding it. Drawdowns, pretty manageable. Some of them hovering around the $5,000 mark or less over a 10-year period. None of them exceed $12,000. And this is what your one of the pages in your TradeStation printout would look like on this combined system with a filter. Gives you a lot of other information, as I'm sure all the other platforms do as well. So, what can we conclude? Well, mechanical trading solves the problem of naturally poor instincts for trading and imposes discipline. Simple is best. It can be very powerful. Again, few rules good, many rules bad. Combining basic elements can create more powerful systems and bigger edges. Okay, this next point we didn't really cover very much. The more validity you get, the more markets and time frames corroborate your winning results, the better it is. Now we're sticking with just one sector, stock-related sectors. I would never want to see a system that kicks the door down in the S&P but completely blows up in the NASDAQ. You know, I'd want confirmation across the board. And finally, and this is something that, you know, I continue to learn the hard way, 99% mechanical is not mechanical. You try to add a little judgment to your mechanical approach, you're going to tend to get the worst of both worlds. So I appreciate you being with me. Little bit of business here. All 5 indicators and the filter are available for a very nominal cost. Very simple English. You don't have to know code. It's $37. My gosh, that's less than 4 S&P ticks. So if you're interested, go to that website, tigersharktrading.com, and you'll get a very easy prompt on how to get this.